Good morning. Welcome to Stock Market Today for Friday, October 19th, 2018. I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can follow me on Twitter at Dan_Russo_CMT and over on StockTwits under the same handle. Stock Market Today brought to you today and every day by Chaikin Analytics in conjunction with StockCharts.com and StockCharts TV. And you can sign up to receive a free email with stock ideas and follow along with this show. Head over to ChaikinAnalytics.com/today. So the combination of Tuesday's rally and Wednesday's high pushed the S&P 500 to within 9 points of the first resistance level, which we've been highlighting near 28.25. Yesterday's reversal lower found support at the rising 200-day moving average. S&P 500 lost about 1.4% on the day, while the NASDAQ and small caps underperformed. Consumer discretionary and tech were the biggest laggards. The defensives led. The dollar was weaker on the yen, but stronger against the euro and sterling. Treasuries were mixed with a bit of curve steepening. Gold finished up 20 basis points. Oil was lower, down 1.6%. Breadth on the New York Stock Exchange, negative 3.3 to 1. Breadth on the NASDAQ, same thing, negative 3.3 to 1. Utilities, REITs, and staples outperformed. Discretionary, tech, and telecom were your laggards. And futures are actually up this morning, 20 basis points following that big sell-off. Asian equities were mixed overnight. China, big reversal, was down about 1.5% at one point, rallied to finish up 2.5%, but still ended the week down more than 2%. European equities are weaker, with Italy lagging. Treasuries are little changed. Dollar is stronger. Gold up 10 basis points. WTI crude up 60 basis points. And as we look at the structure of the market here, you can see we tested the 200-day moving average again, and that's where support is. 27.68 is your 200-day moving average, and that's first support. Below that, 27.10 to 27.20. Resistance comes into play, 28.25 and 28.52. The RSI, is it shifting to bearish ranges? That's the big question here. Became oversold, rallied back, and have subsequently rolled over. We want to watch this indicator. If that is, in fact, shifting to bearish ranges, that would be a negative momentum sign. Chaikin money flow does remain bearish and is actually turned down once again. So these are the key levels that we're watching. What we're looking for if we do break down and retest this level is a positive divergence here on momentum as well as on some of our breadth indicators. For now, though, the 200-day is acting as support, and we do have a bit of a rally in the futures this morning. So what are we talking about? Your market in a minute. In the email to clients today, we're talking about that retest of the 200-day moving average and the fact that the NASDAQ and small caps underperform. Relative performance of semiconductors remains a concern, as does the breakdown in discretionary versus staples, and we'll take a look at that today. Futures do point to a higher open. If we shift over to the power bars for the major indices, 4 bullish to 2 bearish on the Dow. S&P 500, 63 bullish or very bullish stocks, 101 bearish or very bearish stocks. That index down close to 1.5%. NASDAQ, as I said, underperformed, and that power bar ratio for the NASDAQ has once again skewed to the negative side. Small caps remain an underperformer, down 1.9% on the day. Bonds down tick slightly. According to the Chaikin Power Bar, small cap stocks are more bearish than large cap stocks. Major indexes are mixed. Now, our stock of the day, again, if you're following along in the email, ARNC, Arconic, is our stock of the day today for your consideration. It has a very bullish Chaikin Power Gauge rating due to very strong earnings performance, very positive expert activity, and attractive financials metrics. ARNC went out yesterday at $22.03, down 2.18%. As we look at the stock, we can see it does have a very bullish rating and a strong trend, but the industry group is weak. Looking at the ribbon at the bottom of the screen to tell us where we are and where we've been from a power gauge perspective, we can see we're on that bullish rating. We're very bullish rating and have been since July. And then it was kind of in the September timeframe that the stock began to outperform relative to the S&P 500, putting the market and the model in agreement, putting our dynamic duo in gear. Stock remains above the long-term trend line, which is starting to move higher. Last 3 quarters of earnings have been positive surprises. I will note that they do report on October 30th, so inside of 2 weeks. So Stock is currently oversold. Money flow is kind of neutral. This is, I think if you want to play long side in this one, you do so in a way that limits your risk. Maybe you do it with some call options or call spreads, just given the fact that we are within 2 weeks of earnings, and it's a relatively new outperformer and the industry is weak. I can't argue for wanting to take a bullish stance here, but I think you want to do it in a way that really does define your risk, especially with earnings coming up. Keep an eye on ticker ARNC. I think it looks compelling. I would just given the market environment, I would just like to wait for a little bit of a better setup. Sector movement over the last 5 days, taking a look at how the major sectors have performed. Communications has been outperforming over the last 5 days, up 3%. Healthcare, being our market darling. It's one of our favorite sectors of the market. We view it as leadership, up nearly 3%. And then you can kind of see a little bit of the defensive nature of the market. Staples, real estate in the top 4. Tech, nice little rebound, although kind of rolled over yesterday, so we'll see how we do today. Utilities, middle of the pack. The pullback in oil has really weighed on energy, and materials just continues to be a sector of the market that we want to avoid. We've been avoiding it for a while. Just doesn't look all that compelling. Financial seeing a little bit of a rebound. We want to see that continue for the health of the market. However, our industry in focus today, bank services, paints a pretty bearish picture for that sector. Over the past 6 months, bank services has underperformed the S&P 500 by 12.7%. And its power bar ratio, which measures future potential, is very weak, with more bearish than bullish stocks. Currently ranked number 14 of 21 subsectors that we look at. It has moved up 6 slots over the past week. We can see there's only one bullish or very bullish stock for 8 bearish or very bearish stocks. And some of the indicative names here: First Republic Bank, FRC, and Lending Tree, TREE, have very bearish shake-in power gauge ratings, and Investors Bancorp, ISBC, has a bearish shake-in power gauge rating. And we'll take a look at one today because I think it's getting to a compelling setup level. This is Lending Tree. Ticker TREE closes at 214.09 yesterday, down 2.08%. Very bearish stock, weak trend, weak industry. So at the very least, we know we want to avoid it. We also think that this is compelling hunting ground for potential bearish trade ideas. Ribbon at the bottom of the screen, where we are and where we've been. You can see we've been bearish really since May, and we've been underperforming the market since April. The intensity of that underperformance remains intact. So dynamic duo in gear, market and model in agreement, kind of sets up as a compelling entry point for an idea on the short side of the market. Becoming overbought, bearish money flow, tried to rally back to the 21-day moving average, remains below the declining long-term trend line. Only thing that really kind of hangs me up for a trade here is the fact that they do report earnings next Thursday. I think if you want to play the downside in Tree, again, it's another one that you should do in a risk-defined way. Potentially look at vertical put spreads as a way to express a bearish view on Lending Tree, but at the very least, not the type of name that we want to own. Taking a look at what's trending, yesterday's S&P 500 movers. And a lot of this is earnings related. Genuine Parts, ticker symbol GPC, up nearly 6% following their earnings announcement. ADS, same story, 5.5%. Market like what they heard there. Perpetual bear, Philip Morris, finally put up some numbers that the market could get behind, up 3.5%. And the power gauge rating, which had been bearish or very bearish for a while, has now turned to neutral. AutoZone, ticker symbol AZO, no news there. It was up in sympathy with GPC. And Macy's up nearly 2%. Couldn't really find a good reason why. On the loser side of the coin, URI citing some pricing pressures in the rental business, and the market did not like to hear that, down 15%. Textron down over 11% on its earnings. SNA down nearly 10% on its earnings. SEEE, a bearish stock that we've had on a bearish watch list for a while here, has a very bearish shake in power gauge rating, down 8.3% following their negative pre-announcement. This was not an earnings release, it was a pre-announcement. And Activision Blizzard, ATVI, down over 8% on the day. That is a neutrally rated stock. So if we look at kind of the earnings recap, Thursday's surprises, Travelers, TRV beats by 32 cents. There's Philip Morris beating by 16 cents. And this is a little bit of a turnaround. Philip Morris is a name that I'm going to kind of keep an eye on because it's been beaten down for so long. Sentiment on this name is so bad that if things start to improve, I'm watching this one for a power gauge. If that power gauge turns positive and some of the other factors get into line, it might be a compelling idea from a contrarian standpoint. PayPal, we said to keep an eye on it. They beat. Stocks trading higher. American Express beats by 10 cents. BB&T beats by 3 cents. And before the opening today, we don't have any bullish stocks reporting. Some of the key names to watch, Procter & Gamble actually trading higher. STI, important for the financials. KSU, important for the beaten down transport names. Schlumberger, been a perpetual bear here in oilfield services, reporting this morning. Honeywell, important on the industrial side, and VF Corporation kind of give us a little bit of a read on the retail environment. We do suggest caution when holding bearish stocks into earnings. So let's kind of walk through some of the thoughts and ideas. It's Friday. In my note to Chaikin Analytics subscribers, we go through kind of some of the key market themes that I'm watching. And one of the ones that I've been watching for a while, you've seen it here, and it's really the one that's given me the most pause, is semis relative performance. This is the SMH relative to the SPY. And we could, and the reason this gives me pause and the reason I find this so important is because it tends to be a little bit of a leading indicator. Notice that it kind of topped out and went into a range back in November before, going higher with the market. But it was really range-bound trades starting in November ahead of the market's top in January. And now we've been kind of rolling over. We take out the 200-day moving average. Test support, bounce, test it again, bounce, test it a third time, break through. 200-day moving average of the ratio now rolling over. And the RSI appears to have shifted into bearish ranges. We can see just a series of lower highs and rally attempts just can't get out of the bearish ranges. And we've become oversold now twice, confirming the strength of the bearish trend for this ratio. I would like to see this ratio bottom and begin to move higher as a leading indicator that we could be finding a bottom in stocks. I think continued weakness here has bearish implications for the equity market overall. That's why we watch it. That's why I'm calling it out here for you today. This relative performance does still remain a concern for me, as does consumer discretionary versus consumer staples. And what we've done here is we're looking at equal weighted consumer discretionary versus equal weighted consumer staples to kind of neutralize the fact that within consumer discretionary, Amazon is a huge weight, 23, 24%. And this is another indication of risk sentiment in the marketplace. You can see we topped out in June and we've been grinding lower ever since. Take out the 200-day moving average, take out support, and just continue to grind lower. 200-day moving average still rising, but the longer we stay below it, obviously the way the math works, that will begin to turn lower as well. And similar to what we saw on the relative chart of the semiconductors, we are seeing what looks like a shift to bearish ranges for the momentum of this ratio. Again, same story. A stabilization and move higher here would have bullish implications for the market, but continued weakness, in my opinion, would have bearish implications for the overall stock market, as this really is, in my opinion, a barometer of risk sentiment. And the Qs are nearing a tipping point, right? Our high growth, our momentum stocks. We're looking at the Qs relative to the SPY. They started going sideways in June, and they've subsequently weakened. Still above a rising 200-day moving average, but I think that that's the tipping point, especially in light of the fact of an RSI that seems to be shifting lower, and on an absolute basis, the Qs are kind of testing support. So let's keep an eye there. I think if they hold and can rally, that would be bullish, but a breakdown would obviously have bearish implications. So we're kind of like, there's a lot to watch here in the marketplace for the time being to try to give us a clue as to which way we might resolve. So I just want to say happy Friday, everybody. Sign up for the email, chaikinanalytics.com/today for stock ideas and to follow along with this show. And if you like what you're hearing, so help us spread the word. Share our link on social media. Hope you have a great weekend. See you Monday.